Okay, so let's get into pensions, investments, these types of topics. So what are some of the departure year investment planning issues? So the first one is in the year of departure, a lot of people say, so can I contribute to my RSP because I'm a non-resident? You can. You maintaining an RSP in Canada as a non-resident or a registered pension plan from your former employer where they would likely have rolled it into a LIRA, a locked-in retirement arrangement, you can leave those investments just as they are. Those aren't going to have any impact on your residency status. They are technically secondary ties, but those secondary ties I don't feel are material enough to your situation, and nor would anyone want to, or rarely do I ever see anyone relinquish their RSPs just because they departed the country. So you would just leave things as is. It's important that you let your financial institution know that you're a non-resident, because if you ever do draw that pension as a non-resident, there's a flat 25% withholding tax on the income that you draw from it. So it actually could be a tax savings depending on the marginal rate you would have been in Canada had you drawn from the RSP. So 25% might not be too bad, but unless you're going to draw it in your retirement years or you need the funds, you would just leave it as is and let the financial institution know that you're a non-resident. Now, in the year of your departure, a lot of people do choose, and I usually recommend it, that you contribute to your RSP for that year of departure. So let's say you worked in Canada for half the year, up until June of a certain year, and then you departed. You'd probably want to contribute to your RSP because that's going to bring down your earned income. That's going to be calculated in your departure return. So your overall marginal tax rate would go down. But if you've got carry forward room or you choose not to use the room that you've generated in the past, that's okay, because the RSP contribution room carries forward forever. A lot of people have been asking about the TFSA. What is that? It's called a tax-free savings account. It's something new that the government started back in 2010. Or 2009, I think. And what it allows is it allows each individual to contribute up to $5,000 to this plan each year, and it grows on a tax-free basis. You don't have to worry about that living in Hong Kong because you're tax-free on all your investment income anyways. So no one should be contributing to the TFSA as a non-resident because there's a 1% per month penalty for having funds within the TFSA if you contributed them as a non-resident. So let's say you left in June of a year and the month prior to your departure you contributed your $5,000 of room to the TFSA. That's okay because you contributed as a resident. You just can't contribute as a non-resident. Another question that came up this morning was, what if I have a home buyer's plan? So do you remember in Canada when you did live there, if you purchased a home, your first home could be, you could borrow up to $20,000 from your RSP, and that $20,000 was then payable back over a 15-year period to your RSP. If you become a non-resident, you have to repay the home buyer's plan within 60 days of becoming a non-resident, or it gets added to your income for that year. So just something to be wary about if anyone maintained or took out a home buyer's plan. Canadian and foreign pensions. So one thing to be aware of with Canadian pensions is, back to what I was saying before, is if you do draw from it, you're going to be subject to a non-resident withholding tax. I'll talk a little bit later about what happens if you're a resident and you've got a foreign pension that you're drawing into Canada. In your residency status, is important that you let your financial institutions know that you're non-resident again, because they're required to do the withholding tax if applicable. So the non-resident flat withholding tax of, say, 25% on dividends. But if you don't tell them, they're not going to know. So it's important that you pre-plan or inform them after the fact, just so that they're aware. Now, what about if you come back? So this is probably more important for all of you that are in this room, because you might one day come back. So what happens in the year of your arrival back is there's any of your foreign assets. So I'm going to talk about pensions, investments, and, say, property as three major ones. So what happens with your investments? So you've got investments here in Hong Kong. You have a choice. You can leave them here as is and move back to Canada and let them continue to do what they're doing. That's not a problem. But if you do that, there's going to be something called a deemed acquisition on the day you come back. So back to my simple Microsoft example before, you're living here in Hong Kong, you buy shares for $5. The day you arrive in Canada, they're worth $7, and you sell them for $10. So Canada's going to tax you on the difference between 10 and 7. They're not going to tax you on any growth that occurred up until your date of departure. Now, If you say, well, why don't I just sell everything and move the funds back to Canada, you could do that as well. Canada's not going to tax you on any of the growth as long as you do the disposition prior to your arrival. If you do it after, then we have to take that deemed acquisition value into account. So that's something you've got to decide before you move back to Canada. Do you want to keep your investments housed here in Hong Kong? Or do you want to do that and then have new investments in Canada? It's up to you. There's nothing wrong with investing abroad if you're a resident of Canada. But you do have to be aware that you're being taxed on any income on those investments from your arrival date forward. So if you're in dividends or interest or any sort of income from the foreign investments, those will be subject to tax, but only from your arrival date forward. None of the pre-income is going to be subject to tax. Now, a question that came up this morning that comes up every time I do this presentation is, what if I've got savings here in Canada and I sell all my investments, I liquidate to cash? How do I bring the cash back, and am I going to be subject to tax on the cash? You won't be subject to tax on the cash because you've earned it as a non-resident, and now you're just bringing the funds to Canada. The best way to bring the funds is via wire transfer, I believe, because it's really an interbank transfer. The bank's communicating with the bank to ensure that it's legitimate funds and it's not, you're not a bad guy bringing funds to Canada. And you can send the funds in any allotment you want. It can be, you know, $10,000, $100,000, $3 million, it doesn't matter. A lot of people think that little question on the plane, you know, when you fill out the card on the way back and it says, are you carrying currency more than $10,000? That's just a security question because the immigration authorities don't want bad guys to walk in with big wads of cash without telling them. So you just tell them you're not a bad guy and they let you in with however much money you got. So in the case of you arriving back as a resident, I would recommend that you send the funds via wire transfer, and you can do it before you arrive or after. It doesn't matter. That's up to you. Be aware that if you do have foreign assets while a resident of Canada, you do have to report them on a form called a T1135, which is the reporting of ownership of foreign property if the cumulative foreign property is greater than $100,000. So that would be for the year of your arrival and every year thereafter. So that's a T1135, and you must look at that form and determine if you're required to file it, because there's a $2,500 penalty for non-compliance if it's required to be filed in that year. It's required to be filed by April 30th of each year for the prior year. So if you come back in 2013, it's due by the end of, or by April 2014. Okay. Again, we talked about the TFSA. Do not open a TFSA as a non-resident. I've seen so many expats do it when they come home in the summer. They meet with their financial advisor, and the financial advisor says, open up the tax-free savings account, and then they don't realize that they're going to get hit with this 1% per month penalty. Again, with the RSPs, if you have carry-forward room, no problem. You can keep it as is and continue to earn it while you come back to Canada. Now, what are the other two categories? Let's talk about, well, let's give an example of you moving back. So what if you have foreign property here in Hong Kong? Let's say you live in an apartment or a flat that you've purchased, and let's say you buy it for $500,000. And on the day you arrive back to Canada, you decide, okay, I want to rent it out to a stranger because I might come back one day, or I might want to wait and sell it in the future. Then your new cost base for Canadian purposes is whatever the value was on the day of your arrival. So then, very similar to the stock example, you're only going to get taxed on any difference between the value when you arrive and what you sell it for. Now, if you earn rental income on the property in Hong Kong, irrespective of whether it's in a loss or a gain position, you've got to report that rental income and expenses on your Canadian return. Okay, so you're still going to report all that in Canada, but if you pay tax in Hong Kong, you can claim a foreign tax credit on it in Canada, so you're not double taxed. Another one is, well, what if you've got pensions here? So if you've got a pension here in Hong Kong, you've got to determine if you can relinquish the pension before you depart. If you do, then there's no taxation on the pension in Canada because you've disposed of it prior to your arrival. If you maintain the pension and let it grow, and then you draw from the pension in the future when you retire, just be aware that you'll be subject to tax on the pension income as you take it into income in Canada. So if you take $10,000 a year from your pension, minus whatever tax you pay here, if any, Canada is going to want you to include it in your Canadian return. We talked about sale of shares of foreign accounts, so you'll still have to record the capital gain in Canada if you've got foreign income from other sources. Another item is bonuses. So let's say you've done a great job, you leave your employer and they say, okay, we're going to give you a bonus, but we're going to pay it out next month, and you rush back to Canada to become a resident again, and you get the bonus. Canada's going to tax the bonus, unfortunately, because you received it as a tax resident, even though you earned it while you were abroad. So it's kind of not fair. So just take a wicked vacation, get all your money, pack it up, and then come back to Canada so that you don't pay a portion in income tax, because you could probably stay at a really nice hotel on a beach somewhere for the amount of tax that they're going to take. Now, everyone always asks about the treaty, and there is no treaty between Canada and Hong Kong. There is one between Canada and China. There is talk of a treaty coming into force between Canada and Hong Kong shortly, but they're proposing the date of January 1st, 2013. I don't think that's going to happen, because typically treaties take a number of years to be ratified. But if they do bring out a treaty, it's probably likely going to be very similar to the Canada-China treaty. And where this could help you is back to when I was talking about owning, let's say, a property in Canada and not leaving it available for your use or having it empty, because that could be seen as a residential tie. When we look at a treaty, we look at the ties you have in both Canada and the country that Canada signed the treaty with. And there's a tiebreaker rule in the treaty that says you can only be a resident of one of the two countries at a time. You can't be a resident of both countries. But in the situation you're all in right now, because there's no treaty with Hong Kong, Canada could conceivably see you as a resident, but so too could Hong Kong. So you could be a resident of both countries from a tax perspective. So if that does come into play, it would be great, because it's going to really help people that come to Hong Kong determine their tax status from a residency perspective, but then always have the treaty to kind of fall back on to determine where they're really a resident between the two countries. It could also mean that there could be a reduction in withholding rates, so that 25% withholding rate I was talking to you about in terms of dividends, that could be reduced based on the treaty. So that's where it could be preferential. Just one thing I forgot to highlight at the beginning is the whole concept of tax residency is based on your residential ties and is not a legal status of residency. So it's not to be mixed up with your American friends that have a green card or citizens of the U.S., because they're technically residents forever. They're tax residents and they're legal residents. You're all still legal residents if you're passport holders and citizens, but you can become tax non-residents of Canada just because we follow a British concept of taxation based on where do you primarily live, where do you carry about your day-to-day activities. And if that's Hong Kong, then you're definitely a resident of Hong Kong and a non-resident of Canada. But it's important you look back at some of these ties and other issues for not only when you come down to, or when you've come to Hong Kong, but especially for all of you in this room if you ever do come back. You've got to do some pre-planning in terms of what you want to do with your properties, your investments, your cash assets, and how you'll administer all that once you do move back to Canada. So something just to be aware of. So just one thing, if you've glazed over and forgotten a lot of what I've talked about today, we do a quarterly article for a magazine called Canadians Resident Abroad Magazine. So if you go to cramagazine.com, you can read up about all these different topics, because we've tried to cover one every quarter. I'm hoping we don't run out of topics, but my colleague Wayne just did one on pension planning for expats. That was in the last issue, which came out in October.